Do you enjoy having those dividend payouts roll into your portfolio? Today I'm going over 7 stocks that have great dividend safety and growth scores that will be great additions to your portfolio. Be giving an overview of the stock and the company, looking at some sector comparisons, and of course looking at dividend stats. So let's dive in. First up is Texas Instruments Incorporated, ticker symbol TXN. They are in the information technology sector, and they design, manufacture, and sell semiconductors to electronic designers and manufacturers worldwide. They have two different business segments, the first being analog, which offers power products to manage power requirements, and the second is embedded processing, which offers microcontrolling that's used in electronic equipment and digital signal processors. For the start of the year, Texas Instruments have fallen 2.74%. However, for the last month, they have grown 20.13%, giving them a current share price of $185.38. They're trading above their midpoint, close to their high of $202.26. Their current market cap is $169 billion, and they're trading at a PE of 19.36. Signoff gives their revenue growth a grade of C- with a ratio of 11.02%. That's about 23.81% lower than the rest of their sector. As far as profitability for their net income, Signoff gives them an A+ with a ratio of 43.78%. That's about 919% higher than the rest of their sector. Looking at valuation for their forward PE, Signoff gives them a B- with value of 19.36. That's about in line with the rest of their sector, according to Signoff. Now looking at their dividend summary, their forward dividend yield is 2.48%. That'll give you an annual payout of $4.60 with their payout ratio of 47.56%. For the last 5 years, they've been growing this dividend at a rate of 18.13%, and it has been consistently growing for the last 16 years. Signoff grades their dividend safety as an A and their growth as an A+. Also put on here dividend tracker, and they gave it a safety score of 86. Now, Wall Street analysts are considering Texas Instruments as a hold with a rating of 3.43 out of 5. And looking here at their price target, Texas Instruments is about $5 above their average price target of $180. Next, looking at Medfast, ticker symbol MED. They are in the consumer staples sector, and they manufacture and distribute weight loss, weight management, health living products, and other consumable health and nutrition products in the US and Asian Pacific. Their products ranges from different snacks as far as bars, pretzels, cereals. They have drinks and smoothies. They also have oatmeal and pancakes and puddings. From the start of the year, they have fallen 36.62%, and over the last month, they have fallen 24%. So I'll give them a current share price of $136.79, and they're trading very close to their 52-week low of $125. Their current market cap is $1.5 billion, and they're trading at a PE of 11.45. Signoff gives their revenue growth a grade of A- with a ratio of 20.21. That's about 211% higher than the rest of their sector. For their net income, Signoff gives them a B+ with a ratio of 9.44%. That's about 84% higher than the rest of their sector. And over in valuations for their forward PE, Signoff gives them a grade of A- with a value of 11.45, which is about 43% lower than the rest of their sector. So Medfast is looking pretty good right here. For dividend summary, their forward dividend yield is 4.80%. They have an annual payout of $6.56 with a payout ratio of 43.93%, and they've been steadily growing that dividend for the last 5 years at a rate of 38.29%, consistently growing for the last 5 years. Looking at their dividend grade, they have an A for their dividend safety and an A+ for their dividend growth. And the dividend tracker gives them safety grade of 68. Wall Street analysts are considering Medfast as a buy with a rating of 4 out of 5. You have an average share price of $214 and a low of $150. So that's about $14 higher than their current share price. Next, I have 3M, ticker symbol MMM, and they're in the industrials sector. 3M operates as a diverse technology company worldwide. They have a very broad range of products. They have safety industrial products that range from industrial abrasive, packing material, electrical products, and material for construction. They have products for transportation and electronics, ranging from ceramic solutions and temperature management for transportation vehicles. They also have healthcare products for skin wound care and infectious prevention products and solutions. And they also have consumer products, bandages, consumer respirators, retail abrasive, and picture hanging. So very broad range of products. You probably have a lot in your house right now. For the start of the year, 3M has fallen 14.35%, and over this last month, they have grown 16%. That brings them to a current share price of $152.24. They're trading very close to their midpoint, with a low of $125. Current market cap is $86 billion, and they're trading at a PE of 14.66. Now currently, Seeking Alpha does give their revenue growth a D- with a ratio of 3.88%. That's about 62% less than the rest of their sector. Growth-wise, not looking so hot for 3M. However, probability-wise is a totally different story. For their net income, Seeking Alpha gives them an A- with a ratio of 11.83%. They're about 75% higher than the rest of their sector. And growth-wise for their forward PE, Seeking Alpha gives them a B-, value of 14.66. That's about 12.5% lower than the rest of their sector. They have a forward dividend yield of 3.91%, which will give you an annual payout of $5.96. Their payout ratio is 60.06%. In the last 5 years, they've been growing this at a rate of 5.3%. And boy, they've been consistently growing that dividend for the last 63 years, making them a dividend king. Their dividend safety score is a B with a dividend growth score of A. And Dividend Tracker gives them a healthy score of 78. Wall Street analysts are considering 3M as a hold right now with a rating of 2.7 out of 5. And analyst average price target is $149, which is right below the current share price. Next up is Procter & Gamble, ticker symbol PG, and they are in the consumer staples sector. Procter & Gamble provides branded consumer packaged goods worldwide. 5 different segments: beauty, conditioner, shampoos such as Head & Shoulder, Herbal Essentials, and Pantene. They have grooming and shave care products, Gillette and Venice. They have healthcare products from toothpaste and toothbrush. They have Crest and Oral-B. Also home care such as laundry detergent, Downy, Gain, and Tide. And also different family care products from diapers, Loves, and Pampers to feminine products, and also paper towels and tissues from Bounty, Charmin, and Puff. So a large variety of different products, just like 3M, and you probably have a lot of them in your house. For the start of the year, they have fallen 10%, and over the last month, they have grown a nice 0.34%. So that gives them a current share price of $146.67, brings them around their midpoint of their 52-week range. So they have a low of 129 and a high of 165. Their current market cap is $350 billion, and they're trading at a PE of 24.71. For the revenue growth, Seeking Alpha gives them a C- with a ratio of 3.80. It's about 44% lower than the rest of their sector. With such a large amount of products, their growth is going to be slower than other companies. They have a nice net income margin with a grade of A+, and they have a ratio of 18.3%, which is about 258% higher than the rest of their sector. As far as their forward PE, Seeking Alpha gives them a C- with a value of 24.71. That's about 22.5% higher than the rest of their sector. Over on the dividend summary, for their forward dividend yield, they have 2.49%, which will give you an annual payout of $3.65. They have a payout ratio of 60.63%, and for the last 5 years, they've been growing that at a rate of 5.58% and consistently growing that dividend for the last 65 years, making them also a dividend king. Looking at their dividend grades, they have a dividend safety score of B and a dividend growth score of A, and Dividend Tracker gives them a safety score of 59. If you're finding value and enjoying this content so far, let me know by smashing that like button, and also consider subscribing to the channel for more stock analysis. Moving on to the next stock, we have EOG Resources, ticker symbol EOG, and they are in the energy sector. They explore, develop, produce, and market crude oil and natural gas. As of the end of last year, they have had a total estimated net reserves of 3,747 million barrels of oil with 8,222 billion cubic feet of natural gas. From the start of the year, EOG has grown 28.42%, and this past month they have grown 15.62%. So that brings us to a current share price of $114.49. They're right above their midpoint with a low of $60 and a high of $145. Current market cap is $67 billion, and they're trading at a PE of 7.29. For the revenue growth, seeking algorithm of grade of B with a ratio of 32.34%. They are about 16.24% higher than the rest of their sector. For their net income, they have a grade of B plus with a ratio of 21.41%. That's about 126% higher than the rest of their sector. And over on valuation, Seeking Alpha gives their forward PE a grade of C plus with a value of 7.29. That's pretty much in line with the rest of their sector, according to Seeking Alpha. EOG has a forward dividend yield of 2.62%, which will give you an annual payout of $3. Their payout ratio is 22.21%, and for the last 5 years, they've been growing that dividend at a rate of 31.75% and growing it consistently for the last 4 years. They have an A for the dividend safety grade and an A minus for the dividend growth, and Dividend Tracker gives them a safety score of 80. Now, Wall Street analysts are considering EOG as a buy right now with a rating of 4.24 out of 5, average share price of $145 with a low of 98. So they're right in the middle of those two price targets. Next we have WSO, ticker symbol WSO, and they distribute air conditioning, heating, refrigeration equipment, along with other products that include thermostats, insulation material, refrigerant, ductwork, plumbing, and also materials for bathroom remodeling. From the start of the year, they have fallen 0.53%, and this last month they have grown 18.34%, which will bring them to a current share price of $302.90. They're trading very close to their 52-week high of $318. Their current market cap is $10.42 billion, and they're trading at a P ratio of 20.85. Seeking Alpha gives their revenue growth the grade of B minus, with a ratio of 13.02% and 25.5% higher than the rest of their sector. For a net income margin, Seeking Alpha gives them a grade of B with a ratio of 7.56%. That's about 12.26% higher than the rest of their sector. As far as their forward PE, Seeking Alpha gives them a C minus, value of 20.85. That's about 24.5% higher than the rest of their sector. So they are trading a little bit at a premium compared to their sector. For their dividend yield, they have a forward dividend yield of 2.91%, which will give you an annual payout of $8.80. Their payout ratio is 59.76%, and they've been growing that dividend at a rate of 13.53% for the last 5 years and have consistently grown it for the last 8 years. They have a dividend safety score of A+, along with a dividend growth score of A+, and Dividend Tracker are giving them a dividend score of 58. Now, Wall Street analysts are considering WSO as a hold right now with a rating of 3.25 out of 5, and their average price target is $267, which is about $35 lower than the current share price. Next up is Coca-Cola, ticker symbol KO, and they are a consumer staples sector. Now, as many as you all probably know, they are a beverage company that manufactures, markets, and sells various beverages worldwide. They have 200 different products that range from sparkling soft drinks to flavored enhanced waters, sports drink. They even have teas, coffee, and energy drink. From the start of the year, they have grown 7.42%, and this last month they have grown 0.58%. So I'll bring them to a current share price of $63.70, and they're close to their 52-week high, which was $67. Their current market cap is $275 billion, and they are trading at a PE of 25.9. So it is a bit more on the premium side. For their revenue growth, Seeking Alpha gives them a B minus with a ratio of 9.97%. That's about 46% higher than the rest of their sector. For their net income, Seeking Alpha gives them an A plus with a ratio of 23.16%. That's about 351% higher than the rest of their sector. And for their forward PE, Seeking Alpha gives them a C minus with a value of 25.9. That's about 28.5% higher than the rest of their sector. So like I said, they are trading at a premium. Looking at their dividend summary, their forward dividend yield is 2.76%, which will give you an annual payout of a nice $1.76. Their payout ratio is 70.49%, and then for the last 5 years, they have grown that dividend at a rate of 3.62%, and they have consistently grown that dividend for the last 28 years. So they are a big company, so their growth rate is going to be smaller as they get into the higher range of their payout ratio. They have a dividend safe score of B minus with a dividend growth score of A, and Dividend Tracker gives them a safety score of 74. Now, Wall Street analysts are considering Coca-Cola as a buy right now with the rating of 4.12 out of 5, and they have an average share price of $69.57 with a low of $58. So we're right in the middle right now with the current share price of 63. I'd love to know if you have any of the stocks that I went over today in your portfolio right now. Let me know down in the comments. Personally, I have 3M in my portfolio, and also Coca-Cola is on my watch list. Now remember, I'm not a financial advisor, so make sure to do your own research before investing in any of these stocks. If you like more of a deep dive into Coca-Cola, check out my latest video where I go over the fundamentals and compare it to Pepsi. Also, if you're looking for other stock analysis, check these out right over here. Catch you next video. Peace.